So, for those making it, thank you. For those watching on the videotape, thank you for participating in the festivities. Hopefully everyone's going to have a good weekend. So, let's see if we can make it into a great weekend by talking about grantor trust. So, let me cut to the chase because we have a lot to cover tonight. In terms of material, just a very, very gloss over. So chapter 1 talks in general about what is a trust, what is an estate. Chapter 2 is just the fundamentals of what is a trust and estate and how it's subject to tax under the general principles of the income tax code. It's subtitle 1, general income tax principles. Chapter 3 deals with the notion of D&I and simple trust, complex trust, and how trusts get, for example, the very last year, how Code Section 642H applies. And at the very, very end of Chapter 3, we spoke about the application of Code Section 642E and how distributions, if made with property, not cash, but rather property, that you look right at the lesser of the fair market value or adjusted basis of the property in order to determine the amount that possibly could be taxable. This is assuming Code Section 663 does not apply, right? Code Section 663 deals with specific bequests, right, that do not pull out D&I. When we talk about Code Section 642E, we're talking about those kind of distributions that do pull out D&I. In addition, keep in mind, for those watching in the videotape, do not forget one case and one case alone. And that case would be, that silence is not the video. That's the silence.
In the whole book, or?
Not in the whole book, that segment towards the end of Chapter 3, dealing with distributions of property. And that case is the one case, Keenan. Right, Keenan. Right? K-E-N-A-N. Do not forget Keenan, because that's a case that you should remember from your income tax course. You can remember it in the context of this course. The proposition that if you satisfy a debt with appreciated property, it can give rise to gain recognition. Okay? So, just Keenan is a case everyone should have. It's one of the, every course has like 5 or 6 cases that you should try to retain. And I think, can I speak for the class here? That certainly in Chapter 2, what was the case that probably gave you a big headache, but now when you saw it in retrospect, it's not that bad. Manufacturers Hanover, right? Why? Because it just illustrated how to compute those expenses allocable to tax-exempt income. So in this course, probably the big cases are Keenan, Manufacturers Hanover. I will venture to say in Chapter 4, 1 or 2 of the big cases would be, in my mind, at least the one biggie in Chapter 4. Clifford. Even though it's defunct, it really set in motion grantor trust, right? So the Clifford decision, this notion, and Clifford is an offshoot of the Lucas v. Earl realm and the fruit in the tree, and Helvering v. Horst, where if you have enough control and dominion over property, you're deemed taxable on the income that property generates, right? And in Clifford, this person set up a trust, if you recall, that notwithstanding it was irrevocable, nevertheless was considered the equivalent of a grantor trust, and the grantor was going to be subject to tax on it. So there you have 3 essential cases that I think would be useful outside the classroom to consider for subchapter J. So we started looking at chapter 4 last class. Keep in mind with respect to chapter 4, and today should be the finale in chapter 4, and we're looking at grantor trust. The authors start off with the assignment of income doctrine, this notion of controlled dominion. We looked at the Clifford case, and then we took a glance at Code Section 671. We'll take a closer look towards the end of this class at Code Section 61. What are the implications? Code Section 61, Code Section 671 delineates the implications associated with having a grantor trust. Code Section 672 deals with definitions. What is an adverse party? What is a non-adverse party? Some important definitions that we will see are applied later or throughout. Check this subpart. And then what we did after looking at Code Section 671 and 672, we then turned our attention, because if I recall correctly, I don't know who was, I think Karen, maybe you were holding up your fingers. We decided that there were 6, right? 6 identification sections that we were going to look at to figure out if something was a grantor trust. And the first of the 6 that we looked at were reversionary interests, right? And if you had a, excuse me, not you, but if your client established a trust in which at some, after a term of years, or after the life of a beneficiary, the trust would revert to the grantor, and the actual interest of that was in excess, was 5% or more, and it was considered a grantor trust as to the whole. Okay, and this is dramatically different from old Code Section 673, because Code Section 673 used to say if it were more than 10 years, then it would qualify as for non-grantor status. Okay? So Code Section 673 now is much more expansive. And I told you last class that in all my years of practice, I've never seen a trust with a reversionary interest. People, that is not something people typically, traditionally put in trusts. We looked at Code Section 674, power to control beneficial enjoyment. And certainly the code starts off generally that essentially any trust set up in which anyone can control beneficial enjoyment takes it a grantor trust. But then we see the exceptions delineated in 674B, C, and D that really narrow the application of the general rule such that the general rule is really the exception and not the exceptions are the general rule. What my intentions are tonight is to go through 675, 676, 677, and 678. 4 different code sections, and just highlighting whether or not you can identify, based on those 4 code sections, what is a grantor trust. And once we identify it, time permitting, at the very end of class, there's one segment dealing with, okay, now that you've identified it, what are the tax consequences? Keep in mind, we do have class this upcoming Wednesday, and keep in mind, everyone here should have received an email from me, and those watching on the video should have received 2 chapters that I helped craft one dealing with charitable trusts, and the second dealing with IRD, Code Section 691. And this upcoming Wednesday, we'll go through the charitable trust chapter, and our last class we will deal with the IRD chapter. If you don't have those chapters, those watching on the videotape, shoot me an email, I'll resend them, okay? Hopefully you have them. Good news, I think I told you on Wednesday, but we even got more people. We're over 50 people signed up for a week from this Friday night. So a week from tonight, guys, instead of being here, hopefully you'll be one floor higher.
You have to sign up.
You got to sign up, that's right.
Yes, please.
Please, sooner the better, just so we can get the right numbers with the
Do I
catering.
just email you?
No, you have the Eventbrite. You should be able to get it.
I don't know what that is.
It's an email that you can go onto Eventbrite and you double click it. And if you can't find it, Simone, just let me know. I'll send you the link.
Okay.
All right? And if you want, bring a guest. And like I said, I got to incentivize people. If I can't twist anyone's arm, maybe if we can't get a volunteer, I may have to give away points for a final exam. But we'll see. Hopefully it doesn't come to that, and people will volunteer. Like I said, the first time in my life, I'll actually know everyone in the crowd. So unless the hypnotist brings someone to just, not be that person, but I'm going to ask that person tax questions just to test them, to make sure that they're really one of us. All right? All right, so we're all good? Any questions logistically?
In terms of the exam review, will you be available the following week?
I'm around I'm just going, literally, I am going to New Orleans Wednesday night, monitoring Thursday. I am taking a 6 a.m. flight on Friday.
Oh, we should stay for the weekend. It's so much
should.
fun. It's so much fun.
But my wife and I always joke that I'm such a loser, that I was the guy in the library, and she was the woman in the library, but together the two losers hopefully are winners. So that's our little thing. So you're right, I should be enjoying New Orleans.
I mean, it used to be better, but now.
But I got Simone has questions. I got to be responsive. So I got my priorities right. At least I hope so.
Who's the other speaker, by the way? Is he a professor here as well? Or I didn't recognize the name.
Kornstein.
Oh, the two speakers on Thursday are both.
Well, no, we've had Falk before.
Falk, Kornstein, I recruited him. He's a partner in McCarter English. He's one of the big partners in McCarter English. He's very good. He's very nice. Very
Okay,
good.
I was just wondering who he was. I didn't recognize the name.
Yeah. Okay. Any other questions? Okay. So let's talk about administrative powers. Because if you have enough administrative powers, potentially you can have indicia of control, dominion and control. And I told you last class, just to remind people, what I said in my own practice, and I think I speak on a national level, what I see in terms of having intentionally defective grantor trust, that many people purposely use Code Section 675 4C, if you recall from last class, this power of substitution to purposefully create grantor trust in the year 2018 and going forward. So this is not something, some of the cases that we go through about loans, that's not what comes up in practice. I'm just letting you know. But let's talk about 675. Code Section 675 deals with certain powers normally held by the trustee, which can result in grantor trust status. And if obviously 675(1), power to deal for less than adequate consideration. If someone can, if the grantor can essentially buy assets of the trust that are worth $100, say for $10, and there's something in the trust provision, in the terms of the trust that say anything owned by the trust, the grantor can get a discount. Well, that's obvious. There's something I won't say wrong, but it's clear that the grantor controls that. Because a trustee normally, the duty of a trustee is what? To maximize the value of a trust. Agreed? And if one of the obligations of a trustee is to give these sweetheart deals to the grantor, that is directly conflicting with their fiduciary obligation. So obviously the grantor is exerting pressure, right? So 675(1) should be pretty obvious. That's truly a tremendous indicia of control. 675(2), power to borrow without adequate interest or security. Again, take a step back. What do fiduciaries do? They protect, right. Conserve. So if I'm a trustee, do you think I'm ever going to lend money without adequate interest or security? No. It's an anathema, right? To do that. And I would never do it, nor would you. And if the trust says it can be done with respect to the grantor, well, that means that the grantor is carving out a special interest, and as such, it warrants grantor trust status. By the way, I'm leaving my phone on because you guys have been through this drill before. Theoretically, it's 7:30 during our break. Hopefully, some pizza will come, and I think V has been kind enough. I was a taster on this. She has made, and for those on the videotape, I'm sorry, I can only tell you this, and it's not to, how do I say, frustrate you, but V made some tremendous pumpkin cake that is really amazing. So maybe for the final exam, you'll inspire students to come. How's that? So 7:30, guys. Let's see if the phone rings, and if it does, that's the reason my phone is on. All right. So power to borrow, we said, with adequate interest or security, problematic. Theoretically, if this power extends to anyone and everyone, like whoever drafted the trust said, oh, I don't care if the trustee can lend money with adequate interest or adequate security or interest. If it's a universal, well, then it's not considered violating the grantor trust principles, okay? So there is a carve out there. I don't know too many people who are going to do that, but it could theoretically happen. But if the loan is actually made, then you run afoul or potentially run afoul a 675(3). So 675(2) just deals with the mere existence of the power. 675(3) deals with the actual lending. Okay, everyone see the distinction? One is the existence, one is the actual lending. All right, so let me pause for a second and let's look at this case, Benson. It dealt with unsecured loans. We have in 1968-69, someone bought real estate for an appliance center in his individual name, and he moved the appliance business to the property. Then released the property to a corporation, and then deeded the property to the short-term irrevocable trust. So picture, if you will, without getting too complicated, is that the taxpayer here deeds valuable property to a trust, okay? Deeds valuable property to a trust. And the property itself was subject to a large mortgage that they're going to remain personally liable on. So picture, just to exaggerate the facts, that the property is worth $1 million and the taxpayers borrow $1 million. So the property is subject to a $1 million obligation, and they contributed to the trust, and they remain liable on that debt. The trust, guys, no shocker to anyone in this room. It's going to be for 10 years and 10 days. Why? Well, because all these are, because they don't want to run afoul of the old Code Section 673, right? That they're going to be more than 10 years, right? Some are 10 years in 1 day, some are 10 years in 2 days, some are 10 years, in this case, 10 days, right? Anything to exceed 10 years. So, under old law, it was not considered a reversionary interest. And all income is to be paid to the 4 minor children. And the wife is the trustee. And the wife has the power, in the terms of the trust, to lend to any person, and there's with reasonable interest and security. So there's just a generic provision that allows, that's not going to run afoul of Code Section 675-2. Okay, so there's nothing in the trust that runs afoul that would make it a grantor trust. Whoever drafted this trust tried to be very careful so it could avoid grantor trust status and essentially let the children be, there was no kiddie tax. Let the children be taxed on the income at the lower tax rates, right? So, looks like whoever did this lined up all their ducks, right? But, by the way, even if, I'm just making this observation, even if the trustee didn't lend at inadequate interest or there's no security, in other words, if you have a trustee that violates the terms of the trust in some form or fashion, just like we had last class, if you recall, where a grantor set up a trust and notwithstanding did all the legwork and the trustee delegated and said, okay, whatever you guys, you know, essentially we came up with the word, right? It was sinecure,
yeah.
sinecure, right? Even if a trustee violates the terms, it will not make it a grantor trust. In other words, the terms or the actions of the trustee will trigger grantor trust status, but if they fail to do A, B, or C, their failure, where they somehow turn over the reins of control to a grantor, will not trigger grantor trust status, okay? Again, if you recall, Code Section 671 says specifically, either you meet the requisites spelled out in the code sections enumerated or you don't, but there's no more touchy-feely, Clifford-like decisions that we're gonna render here. So even if you or the grantor exercises a lot of control, doesn't matter. The terms of the trust are what dictate the outcome. Okay? Now, the question is, was a loan made here? Okay? And why? Why is that an issue? Does Code Section 675-3 apply here? Does Code Section 675-3 apply? And Code Section 675-3 says a portion of a trust will be treated as a grantor trust if the grantor has borrowed money and is not repaid it at the end of the year. And when you read this case, you know what, I was getting a little bit confused with this in the next case where there was already a debt on the property, but here, beginning on page 276, she did lend money, right? This is spelled out in the third full paragraph. Petitioner, June, as trustee, made several loans to the grantor. Each of those loans was unsecured or interest at 8% was represented by a promissory note. So, since there was actual money being lent here, the question is, on what amount should the taxpayer be taxed on? And we have two choices here. The taxpayer's argument says we have a fraction. The loan outstanding over the value of the corpus times trust income. This is the taxpayer's position. The IRS position is that it's trust income times loan outstanding equals trust income. The denominator is trust income. Which one is going to result in more trust income being taxed? The taxpayer? This is going to probably be a very small number. Everyone agree? The loan outstanding, a few $1,000s, right? The value of the corpus is a lot, right? So that fraction is going to be very small. Agreed? That's going to yield a very low number, right? The numerator is going to be fairly small. The loan, dollar amounts. If you looked at the amount the trustee lent, it was not big money compared to the value of the corpus. By way of contrast, if you look at the loan outstanding, that's going to be the same numerator, right? But the denominator, trust income, needless to say, is going to be a pittance compared to the value of the corpus. Hold on. This is, so essentially the IRS, do this, whatever the loan outstanding is going to be equal taxable income, right? From the IRS perspective. See, essentially, suppose, let's just think about this for a moment. In this case, I forget exactly how much the trust earned, but essentially whatever income the trust earned, that money was lent to the taxpayer, right?
It says,
Karen, go ahead.
The rent paid by Benson Maytag was the trust's only source of income, which was $1,700 a month.
Okay.
It's like nothing, right? Even back, whatever, not $50.
Not big bucks.
Okay, so you have Benson Maytag that, okay, makes its money as a home appliance, has to pay rent for this space of $1,700 a month. Now they're bringing it back to their own self and calling it income again at $1,700 for the trust. It's like they're making themselves declare the income twice.
Well, I agree. Hold on. When you say twice, it's never going to be.
The client's company, which is their company, made income. Then got to take a deduction for the rent it paid, right, for lease, you know. But then now this rent is coming back to their own trust. trust as income again, why would you do that?
Well, they were hoping, they were hoping that the money, this rental payments, would be taxed to their children. And it would constitute an offsetting deduction to the company, right? It's not gonna be taxed twice. Karen.
The company's got its own books, right? So-
Right, and that's gonna get a 162 deduction,
Yeah,
right?
for $1,700 a month.
Yeah,
And then it says now the trust income, the only income to the trust is the $1,700 a month.
okay, I agree.
So now it's like, okay, now the kids are getting charged, I mean.
No, but hold on, keep in mind that this is truly a grantor trust. Now, if it is a non-grantor trust, let's pause for a moment. If it's a non-grantor trust, then the kids are gonna get a K-1, and it will reduce the taxable income of the trust, right? As a non-grantor trust, just the rules that we were looking at in chapter 3. So only one party is gonna be taxed, because the trust will get a deduction.
It's not even, okay, but it doesn't even.
If it's a grantor trust,
There's some-
then in that case, mom and dad will be taxed. One way or another, there's only gonna be one tax levy. The taxpayer here was hoping that it would be taxable in our textbook akin to chapter 3. The IRS is saying, no, it should be the entire loan outstanding, which essentially equals the taxable amount, should be the amount that's subject to tax. Now, look, think about this. If a trust generates income and the trustee lends to the grantor the entirety of that income, I have no trouble, and Karen, I think, was voicing her frustration that towards the end of class, that in the notes that follow, the cases seem to be all over the place about what this word portion means, because if you read Code Section 675.3, it refers to a portion of the income should be includable, right, in the grantor's income. And it is hard to isolate what that word portion means. I am comfortable, for exam purposes, that whatever money, this is like, I can be like a judge for 5 minutes, because I guess I'm gonna rule on your exams, but I can say, hey, whatever money is lent, to the extent the money is equal to or in excess of the income that the trust generates, that should be considered taxable to the grantor, right? So if the trust, if you contribute $1 million piece of property to a trust, and it generates $100,000 worth of income, everyone have the visual? And the trustee lends $100,000 or more to the grantor, I'm fine saying that $100,000 should be treated as it's like the person got the money, they should be taxed on it, even though it's in the form of a loan and not in the form of the direct payment, right? And if only 30,000 of the 100,000 is lent, I would say the person's going to be taxed on 30,000. B?
So what's coming out of all this is that just the loan is not a loan, it's just income.
Yeah, I mean, that's what, when you see it, Code Section 675.3 says, treat any loan, that portion of the loan, that if there has been a loan, as if it is grantor trust status, right? The grantor is directly or indirectly borrowed the corpus or income, is not completely repaid, including any interest before the beginning of the taxable year. Right? So for your notes, I'm fine with that. All right? Does this come up in practice these days? Yeah. In the material that follows, I just put down confusion reigns. I mean, you can look at all these different cases beginning on page 280, 281, and the word portion, there is a complete lack of clarity what the word portion means. All right, but I think for exam purposes, I can make it pretty easy, and I think you can too. You know, essentially, B, if you want to distill it down to the extent they borrow the income generated, I hope this is not, no, this is not what, to the extent they borrow the income generated, that's going to be subject to tax in their hands.
And if it's corpus, it's fine.
You know, if you read the material that follows, what's the difference between money being distributed, which is lent as corpus or income? It's still cash, right? So I don't think you want to get into that debate, nor would I. Shane?
What if it says without adequate interest or security? What if it's
If it's what?
what if it's with like adequate?
Well,
interest?
look at code section 675. It depends. It says the preceding sentence shall not apply to a loan which provides for adequate interest and adequate security if the loan is made by a trustee other than the grantor and other than a related or subordinate. In this case, that couldn't happen, right? Because the wife was the trustee. Okay? Now, so again, guys, I don't want to belabor this. It doesn't come up much in practice. I just, you know, it's just one more thing that when you're reviewing the different code sections, a demonstration of control and dominion over the trust is if, hey, the trustee lends you money without adequate interest or security, that's going to be considered as if they distributed income to you. No shocker, right? Now, Rothstein, the United States. By the way, what is stunning about this case, at least for me, and this sometimes happens, if you look at when the taxpayer got a notice of deficiency, it was in the year 1967. Anyone check out when this case was finally decided? When nearly 20 years later, there was resolution to this case. So that is tough. The wheels of justice are certainly moving very, very slowly here. Here the taxpayer wins, but if the taxpayer had lost, can you only imagine the interest that could have accrued here? So I don't know whose fault it was that it took this long to resolve, but there is something that was going on. So anyway, let's just talk about this case. We have the taxpayer together with Sabin formed a company, IDT. Taxpayer pays paid $30,000 for real estate and transferred it to the corporation. Just to remind people, when you transfer property to a corporation, generally is that taxable or tax-free? Tax-free. Tax-free, code section 351, right? Just like when you form a partnership, code section 721, okay? So they contribute property to a corporation, and then the taxpayer transfers the stock of the corporation to the trust, and his wife is trustee. Okay. Several years later, the taxpayer bought Sabin's stock for $500,000. Okay, so picture if you will, the taxpayer buys the other shareholder's stock for $500,000. And the taxpayer purchased the stock from the trust. Remember, he contributed originally to the trust, now he's buying it from the trust. for $320,000. And picture, if you will, I'll play the role of taxpayer. Fortunately, you'll learn I die in that case, but putting that issue aside. So picture, I'm the guy who David and I went into business, okay? So David and I go into business. I contribute real estate to the company. David, I don't know what you contributed. It doesn't matter for my purposes. And I take my stock and I transfer it to Shang as trustee, okay? So Shang, you're gonna role play here, and you get the stock. We're gay couple. We're married, okay? Okay, so you're my significant other, Shang, okay? And we're gonna, what's gonna happen is that some years later, I'm gonna buy David's stock for $500,000, okay? I am then going to buy from the trust my stock for $320. I'm not gonna pay you cash. I'm gonna give you a promissory note, okay, for $320,000, interest at 5%. I am gonna be now 100% owner of the company, 100%. Everyone got that? And now we're gonna dissolve the company. When I dissolve the company, just keep in mind there's two code sections at play. Code section 331 and code section 336. One deals the tax consequences to the shareholder. That's code section 331, and code section 336 deals with the consequences to the corporation, okay? But generally it's a taxable event. When you form a corporation, generally tax-free. When you liquidate a company, generally taxed, okay? Now, so I borrow money after I dissolve the company to pay off David. So David, you're out of the picture now. And there's still a mortgage on the property that was, let's see. I'm just trying to get my facts straight here. Well, the bottom line is I now liquidate the company, and part of it is what is the gain that I have to recognize. And I paid $16,000 of interest to the trustee. And I want to report a loss on the liquidation of this company, because if you look on page 282, if you look at the bottom, the position is the fair market value of the property I received was worth about $1 million, but the basis, or $1,054,000, and my basis was higher than that. So I'd like to take a loss on my tax return. Why is my basis so high? Is because I assumed certain liabilities to the company, and then I bought stock from David, I bought stock from the trust, and that's why I have a pretty high basis, and that's why the purported loss is $33,000. Okay, this is spelled out on page 282. And this was what I was driving at before. Here, remember, when I bought the stock from the trustee, I did not pay him cash. I paid him with a promissory note. Is that considered a borrowing for purposes of Code Section 675.3? Then you say yes, right? The court rules that's tantamount to borrowing. In other words, if I purchase something, even though the trust is not lending me money, it's as if it did lend me money, and then I used cash to buy the stock, okay? It's the same thing. So at the end of the day, the court said that constituted a borrowing, and as such, that triggered the application of Code Section 675.3. Now, once we determine that Code Section 675.3 applies, what are the consequences? Is it going to be treated as a grantor trust? And the answer is yes, right? Because we no, Code Section 675.3 now applies, right? Because it's an indirect borrowing. Why? Again, because I purchased the stock using a promissory note. So now we have to get into what are the consequences. And the IRS would like to take the position, or did take the position, that when I, the grantor, interact with my grantor trust, it's like Code Section 1041. What do I mean by that? If you recall Code Section 1041, any transaction I have with my spouse is ignored, right? You do no gains, no losses, right? Code Section 1041. Similarly, when I deal with Shang, who's not only my spouse and my trustee, the notion is it's a grantor trust, my alter ego, and that we can't have arm's length transactions, right? Because by definition, there is so much dominion and control that it subverts this notion that there can be a real transaction, right? Well, that's what the IRS argued. Was the IRS successful? The answer is no. The IRS was not successful. And the court said, look, all Code Section 671 says is that it says that with respect to a grantor trust, the income, credits, deductions shall be reported on the taxpayer's return. It doesn't say to ignore the transaction. So the judges here simply say, Code Section 671 delineates the consequences. It doesn't say to ignore any transactions, right? Everyone agree that, or at least that's the position of the Rothstein this court, is that you don't have to take those sort of transactions into account. Having said that, okay, oh wait, so let me pause. Does everyone get that? That IRS position is ignore those transactions with a grantor trust. The court's opinion, the one that is upheld, is that the interest is deductible because it says, gee, an interest payment is being made here, and it's being made to a trust, and it will be, even though it's treated as a grantor trust, the income will be picked up on the grantor's tax return, and even though the grantor is essentially paying it to himself, that's, in this case, it would be a wash under Code Section, current Code Section 163. It isn't, because you can't get a deduction for personal interest, and it would be includable under Code Section 61, but at the time, it was going to be a complete wash. Anyway, having said that, the court and the transaction, and this is really critical, is that when Solid buys the stock from Shang, I do get an increase in basis. The IRS position is that when I get the stock, since I can't have a deal with myself, my basis in that stock should have been $30,000, the initial basis. But the court says, no, that's not true. You should have a basis equal to whatever the purchase price, because even though it's a grantor trust, treat it as if you were having a transaction with a third party. So the most critical part, Simone, you got that? Yeah. Is that you treat it as if we know under Code Section 1012, when you buy an asset, you get a cost basis. The IRS position is, excuse my language, shouldn't be on tape, but I'll say it, screw it. The IRS position is, it shouldn't be. Okay, you should not get a cost basis. You should get a carryover basis because the transaction should be ignored. And if you recall Code Section 1041B, if I have a transaction with my spouse, I get my spouse's basis, right? So the same theory applies. This should be a non-event, the IRS position is. And I'll give you a little foreshadowing. The IRS comes back after this decision is rendered and issues Revenue Ruling 85-13, which says ignore all transactions between grantors and their trusts. Okay? The IRS position is currently, in the year 2018, Revenue Ruling 85-13 is alive and well. And in yesteryear, revenue ruling 85-13 was used as a sword against taxpayers. It could have been in Rothstein. But now, guess what taxpayers do all the time? They conduct business with their grantor trust, and they don't recognize gain or loss, and they can strategically, for estate planning purposes, engage in these acts. And they're going unchallenged because the IRS has, until the IRS retracts revenue ruling 85-13, then all's fair in love and war. So, I'm just, if you read the material that follows, Rothstein is out there, and it makes for an interesting case just about this notion of indirect borrowing when you use a promissory note. But the takeaway from the case, you would be gravely mistaken if your takeaway was to say the position of the United States government is to treat transactions with a grantor trust as if they're real based on the Rothstein decision, because in the material that follows, beginning on page 291, the IRS has for the last, scary, 30 years or so, adhered to this position, found in revenue ruling 85-13. And like I said, taxpayers now use it strategically.
So the Treasury regulation had, or the revenue ruling rather, has more authority than the court decision?
It does. You know why? Because taxpayers aren't going to bring cases against themselves. So the IRS has taken a position, and it's not, unless it brings cases, and anyone, if the IRS ever tries to invoke Rothstein, taxpayers can say, hey, I'm relying on your guidance. So it creates a nullity.
So I just confirm one point, the IRS upheld that they're gonna use the carryover basis?
Yeah, that if you have a transaction with a grantor trust that is ignored for tax purposes, that's the IRS position. And 999 times out of 1,000, that's going to be advantageous for the taxpayer. Now, in yesteryear, that wasn't true, but now it is. If the IRS, my 2 cents, had been smart, the IRS at any point can retract a revenue ruling. All right, so I'm not quite sure, I'm thinking out loud why the IRS has not retracted that. So, anyway. Let's look at the problem on page 292. G creates an inter vivos trust. All the income to be paid to C, G's child, for C's life. Upon C's death, the trust is to terminate. The principal is to be paid to C's then living issue per stirpes. What kind of trust is this? Just to remind people. This is a GST trust, right? Generation. It's skipping, right? The child's inclusion in the child's gross estate. This sharing, and we have First National Bank is the trustee. Does Code Section 675 treat G as the owner of any portion of the trust? Is this a grantor trust, in other words, guys? No, right? There's nothing, I mean, it doesn't look like, right, on the face of it, like the grantor, like I said, for exam purposes, take a step back, just at least initially. Does the grantor exercise power over this trust? If your answer is no, right? 4-13. Assume the same facts as 4-12, except that G retains the right to reacquire the trust property upon tendering the trustee property of equal value. Well, EK, you were going to say?
I think
This is a grantor trust. What's your authority?
675.
4C.
Yeah.
Code section 675, 4C. So your answer here, for the answer to 412, not a grantor trust. The answer to 4-13, yes, it's a grantor trust under the authority of Code section 675, 4C. 4-14. Same facts as 4-12, except the trustee is authorized to make loans to the grantor without adequate interest or without adequate security. Is that problematic?
Yes.
Yes. What's your authority?
Good question. Sorry.
675 2.
675-2. Code section 675-2 makes that a problem. However, the second part of the question says, what if the trustee were authorized to make the loan to everyone? Is it a problem any longer?
Well, then the trustee is not preserving the.
No, but if suppose the trust instrument actually provides that power, so the grantor gives the trustee the latitude to do so. Well, look at 675-2. The last sentence there says, except, the clause that says, except where a trustee other than the grantor is authorized under general lending power to make loans to any person. So it would be okay. It would not be grantor trust, the second part of the question, if this power extended to everyone.
Even if it holds up that there's no adequate interest or
Doesn't matter.
Doesn't matter.
Right. Does not matter. So your answer is bifurcated here. The answer to 414 is bifurcated. The first part of the question is grantor trust. The second part of the question, non-grantor trust, right? (4-15). Assume the same facts as 4-12. No language in the trust agreement authorizes the trustee to make loans without adequate interest or without adequate security, okay? So now we're going to change it around, that the trust instrument specifically says you can't do those things. G obtains a loan from the trust, a no interest loan for which he gives no security. G has not repaid the loan. So is that problematic? Yes. What's your authority? 675-3, right? The actual lending itself is a problem. How about B? 14-15B. By G's wife is trustee, G obtains from the trust a market rate interest loan for which he gives full security and he hasn't repaid the loan. So he's going to borrow the money and his wife is the trustee. Is that a problem, guys? Yes, right, B? It's a problem. Everyone agree? Same outcome. And by the way, again, for your notes, yes, the code uses the word portion, but in Solid World, as long as the amount borrowed is whatever it is up to the amount of income, I'm going to say is grantor trust as to that, okay? So notwithstanding all the controversy of fractions or no fractions, we'll keep it real simple, okay? How about 4-15C? Assume the same facts as 4-15B, except that G's partner is a trustee when the loan is made. Would this be a problem?
this partner?
It's not a problem. Why is a partner subservient? Say again? Is it, where would you look? Definitions. What code section? 672 what? 672C, right? C2. And you'll see a partner is not listed as a subservient party, and therefore you do not run afoul of the grantor trust rules here. So the answer to this question is it is not a grantor trust. Not a grantor trust.
What was the answer for B?
It is a grantor trust for 14-15B. 14-15C is not a grantor trust. Ready to move on to code section 676, which the good news is, it's the easiest to identify a grantor trust, I think, and I think you'll agree, are those trusts that are revocable. Talk about a power of control and dominion. If you have retained the right to revoke a trust at any time, isn't that pretty close to actual ownership, guys? Okay, so we'll point out that the grantor is treated as owner where grantor has power to revoke, or non-adverse party has the power to revest title and grantor. So if I set up a trust and I name Simone as trustee and I give her the right to revest the property in me, you know, Congress wasn't born yesterday, and if I specifically give a non-adverse party the power to revest property to me, that's too is going to be considered revocable, right? Because Simone is, maybe she's the bank, right? And banks like to keep my business. So if at any point Friendly National Bank, I set up as being trustee and it has the right to revest the property in me, again, Congress knows or can anticipate that there's going to be hanky-panky, and that it has all the financial incentives to be acquiescent to my wishes, right? So that's going to be a revocable trust. And it points out that there's only one exception, is where I can only revoke with the adverse party. Okay. So, you know, if I give someone an income and interest, and they have to approve of mine, this could be our dinner. And I said, don't come before 7:30, but that never stopped anyone. Hello. Yes, you're supposed to be here at 7:30. Where are you? Okay, you're here early, but we'll break it a bit early. Okay, so I'll be down in about 2 minutes. Okay. Bye. All right. So why don't we do this, guys? We'll pick up. Let's take a 10-minute break. V has she has a pumpkin cake, but let me grab this. Hot pizza is good pizza. Cold pizza is bad pizza, right? So, and let me run downstairs. I'll be right back if anyone.